This video is brought to you by the TLDR socials. Get more from TLDR by following us on Instagram and Twitter, where we post explainers that never make it to YouTube. The link is in the description. Before we jump into what's going on with Evergrande, you need to know a little bit about China's absolutely mental housing market. In the West, we like to talk about our terrible housing crises. We complain about how the median house price is 9 times the median salary in New York, or even 12 times that in London. And to be fair to us wider young people, these are high even by historical standards. For instance, in the UK, the median house price used to be about 4 times the median salary. China, however, as it usually likes to do, takes this to a whole new level. The median house price in China is 17 times the median salary, nearly 3 times that of the UK on average. And it gets even more ridiculous when you look at the big cities. In Shanghai, it's 33 times the median salary, in Beijing, it's 42, and in Shenzhen, it's a whopping 43. And it's not as if mortgages are easy to come by either. Whereas in the UK you can get a mortgage with a 5% down payment, or in some cases no down payment whatsoever, in China, first-time buyers usually require a 30% down payment. Nonetheless, China has one of the highest home ownership rates in the world at about 90%, with 80% owning their house outright. It's estimated that real estate accounts for 75% of total Chinese household wealth. And to put this in context, the home ownership rate in the UK is about 65%, and property accounts for about 30% of all household wealth. So why do the Chinese love houses so much? Well, there are a couple of reasons. First, and most obviously, housing is a fantastic investment. China's house prices have steadily increased since the late 90s, especially in the big cities, which in turn has fueled a lot of speculative investment in the Chinese housing market. Seeing this steady rise, many have used property as nest eggs, investing for the long term in order to set themselves up for retirement or set their children with a sizable chunk of inheritance. The value of property as an investment is accentuated given the fact that other assets like Chinese bonds and stocks aren't anywhere near as attractive. Bond yields are too low to compete with the housing market, and the Chinese stock market is unattractively volatile. So, as China's largest home builder, Evergrande has been at the forefront of this expansion, rapidly building homes to A, satiate customer demand, and B, tap into this booming market, and has since become a behemoth of a company. The issue here is that this growth has come with a huge expansion in its debt, which has led to more and more people scrutinising the company. In 2011, Evergrande was fined by China's Ministry of Finance for providing inaccurate information in its previous financial reports. Then in 2012, LA-based Citron Research published a report that accused the company of fraud, bribery, and reckless spending on football teams. Anyway, Chinese regulators, seeing the huge ballooning of the property market, have, in recent weeks and months, began trying to stabilise the property market, attempting to break a vicious cycle of property speculation and credit expansion. It is now much harder for property developers to raise cash to, develop properties, as well as for home buyers to raise the cash to buy these homes. By making it more difficult to both build and sell homes, China has effectively poured cold water over its housing market. With growth in the housing market therefore slowing, Evergrande has been squeezed further and further, a squeeze it simply cannot afford. In the first 6 months of 2018, for instance, when rating agencies were just starting to raise greater caution on Evergrande's debt, it paid a staggering $4.2 billion in interest on its debt alone. And for some context, that figure eclipses the revenues of 259 of the firms on the S&P 500. As anyone with a credit card will likely know, the riskier you are as a person, the higher interest rate you'll be charged, and the exact same applies to firms like Evergrande. With the housing market slowing, doubts began to creep in as to whether Evergrande's debt was even sustainable, and so a vicious cycle has started. Investors wanted higher returns to cover the risk of default, which in turn increased the cost of servicing Evergrande's debt, which further undermined its ability to repay that debt and increase the risk of default, and so on and so on. This was made even worse back in September 2020 when Evergrande offered a 30% discount on all properties just to try and boost their sales. And at the same time, a leaked letter pleaded to the government for support, warning that it faced a cash crunch. Evergrande's debt problems are ultimately testing China's resolve here, and China has to play a delicate balancing act. On the one hand, merely bailing out the firm and allowing things to continue as they are will do absolutely nothing to stop the property speculation and the associated credit expansion, which is ultimately something it's bordering on becoming, if it hasn't already, a price bubble. And on the other hand, it can't just allow Evergrande to collapse completely, which risks a repeat of the 2008 financial crisis at possibly the worst time for economies globally. But they also can't just wait. Doing nothing could potentially aggravate the problem further as the actions of speculators take over and end up causing a collapse anyway. And when it comes to these bailouts, continuing as they are wouldn't exactly be a good look for China. In recent years, China have been attempting to make moves towards a more disciplined, transparent debt market, one in which a company can default or declare bankruptcy in an orderly fashion and not bring down the entire financial system with it, i.e., have no firm that is too big to fail. Stepping in now to save Evergrande would contradict this transparent image they've been cultivating in their debt market. But if it were to fail, a collapse of Evergrande in the wider property market wouldn't merely affect investors. Homeowners and the wider economy will be brutally affected in what economists term the wealth effect. If you hold an asset like a house, when the value of that asset increases, you feel richer and more financially secure, and so you begin to spend more. More spending means more economic activity, and more economic activity is the definition of economic growth. What matters here is that the reverse also happens. If the asset loses value, you begin to rein in your spending. Activity begins to slow and the economy goes into reverse. Whilst no one is, at this stage at least, suggesting that China is on the brink of a huge recession, with 3/4 of all household wealth tied up in property, this wealth effect could be substantial. And obviously the repercussions for the financial industry would be huge. The People's Bank of China, in its 2018 Financial Stability Report, warned that Evergrande could pose a systemic risk to China's entire financial system. Over 128 banks and 121 non-banking institutions are exposed directly to Evergrande, with hundreds if not thousands more exposed indirectly. And then comes Evergrande's role as an employer. With over 200,000 staff and a further 3.8 million hired annually for individual projects, a significant amount of people's livelihoods are directly dependent on that company. China, beyond Evergrande, has to be careful with how it acts. Whilst it is pouring water on the housing market fire, it runs the risk of extinguishing the flame completely and crashing the entire system. Just how they manage to carefully craft a path through this problem is, at this stage, anyone's guess. So what do you think? Will China step in and save Evergrande? Has China already failed at establishing a transparent modern debt market? Or will there always be some firms that are too big to fail? As always, let us know your thoughts in the comments down below. Also, be sure to follow us on Twitter and Instagram for more TLDR content. You could just follow the TLDR global socials or go wild and follow them all. Following and sharing our posts not only gets you more from us, but it really helps us out and we really appreciate it. And of course, be sure to subscribe and hit the bell icon to be notified every time we post a video. Special thanks to our Patreon backers who make videos like this one possible. And if you want to see your name at the end of videos just like these people, you too can back us on Patreon. The link to that is in the description. And thanks for making it to the end, you absolute legends.